Let's finish more. Okay, so keep that in mind. All right, and yeah, guys, then let's get started. Today what we're going to be doing is we're going to be looking at chapters 5 and 6 today. In the next class, the first 1 hour will be us finishing off chapter 4, and in the second of the class, you all will be introduced to Mr. Dilpahan, who will be taking you all through the grade 13 portion of the syllabus. Okay, so guys, I think you're all pretty familiar by now. If you have any doubts, chat box is there. Please ask me, stop me at any time. If you don't get something, let me know. Okay, so that being said, guys, let's get started. Put my screen up so you guys can see. Just let me know, guys, when my screen is up, and then we can move. Okay, cool. So, guys, let's get started then. First question. The sequence of phases of the business cycle are, you're given 5 options. Okay, so guys, I want you to have a read through the options and let me know what you guys think is the answer. Okay, so this should be a question that we should be able to work through relatively quickly, right? So just have a look through and let me know what you guys get. Okay, so I see a few answers coming in. Very nice to see, very nice to see. Okay, so guys, I'll give you a little bit more, and then we'll discuss. Okay, nice. Okay, so guys, for this question, it'll help if you guys have a clear visualization of what your business cycle looks like. Yeah, so if we take our business cycle here, right, your business cycle generally looks a little something like this, right? It's a cycle, goes up, comes down, goes up, comes down, so on and so forth. So when it comes to your business cycle, we say that there are 4 key stages, right? There will generally be this stage, there will generally be this stage, there will generally be this stage, and there will generally be this stage. Okay, so what happens in scenario 1? In scenario 1, you're on a downward trend. Okay, you're on a downward trend, things aren't looking too good, right? Unemployment is rising, output is falling, right? It's a little bit of a difficult time for the economy. We say that the economy is shrinking or contracting. Okay, so your first step becomes what we call a contraction. Okay, what is this? This is where your contraction keeps on happening and it levels out. You hit rock bottom. This is the lowest you can go. You're in a terrible state and you can't get any worse. So this is your trough. We say this is your trough, the worst place you can be. Okay, right. What comes next? What comes next is what we call an expansion, right? Because you hit rock bottom, right? And now the government says, right, it's time we put our heads together. It's time we come out with a few policies to help boost the economy, stimulate the economy, and get us back to where we were, right? That is what happens in the expansion phase. It's a reverse of the contraction phase where output increases and employment tends to increase as well. It's a good time for the country. All right. And then you hit a peak here where essentially you are at your best. The expansion has worked to full effect. You're at the top where you can be. But the thing is, a lot of people say at this point, inflation is too high. The economy is overheated. It's like a bubble that's this big waiting to burst, right? And then what happens? It bursts. And then you make your way back down in a contraction, trough, expansion, peak, so on and so forth. It's a cycle. It repeats itself through and through. Okay, so that is what happens here. All right. So guys, essentially in terms of the answer here, it would be, as you guys correctly told me, 4. Okay, so very well done there. Okay, so guys, 22 for the most part, pretty simple question. So we'll be skipping that. Let's give 23 a go. What do you guys think the answer of 23 is going to be? So I'll give you guys a little longer for this and then we'll discuss. Okay, okay, nice. Good stuff, guys. Right, just a little more. If anyone wants to send the answers across, they can. And guys, also another thing, right? When you guys are attempting the actual paper, right? The final paper, let's say you come across a question that you have no idea what to write. Yeah, it's a theory area that you don't remember. It's a theory area that you didn't even know was a theory area, right? Or you can't think, you're stuck, right? Guys, in such an instance, remember, never leave an answer blank. Okay, because by leaving an answer blank, you know, you're virtually useless in the sense that you can't gain a mark from that question, right? But by putting an answer, at least you have a 20% chance or 1 in 5 chance of getting a mark there. Okay, and those odds are better than not having an answer at all. Okay, so get into that habit, guys. Even at the actual exam, even if you have no clue what this question is about, pick something. Okay, you never know. If there are maybe 5 questions in a paper that you're not sure what the answers are, even if you get 2 of those right by chance, it's good, right? Those are good odds. Okay, so let's take a look at this question. But before we do that, guys, we need to familiarize ourselves with the difference in 2 concepts. Okay, real and nominal. Okay, so if you guys already know what this is, you can put it in the chat. Maybe just a few short words as to what your explanation of these 2 are. But for the sake of discussion, let's look at the difference between what a real change is and what a nominal change is. Okay, so guys, let's say initially, right, you had a person in year 1. Okay, he's starting out in a job. Okay, he's starting out in a job and he makes $1,000 a year. Okay, he makes $1,000 a year. All right, so with his $1,000 a year, he can buy one good. Okay, this is the only good that exists in the whole world. This is the only good you can buy. Okay, so essentially, when it comes to this, right, this person is earning a salary of $1,000. That good costs him $10. Therefore, how many goods can he buy in year one? He can buy 100 goods. He can buy 100 goods. Okay, right. So this is what happens initially, year one, right? First job. This is how much he earns. Okay. Now we skip a couple of years into the future. Okay. And this same person is now earning big money. Okay. He's got a promotion. He's been putting in good hours at work, right? And he gets the jump, right? He gets the jump and now he earns $3,000. Okay, it's taken him about 5 years to do it, but he earns $3,000. Pretty great, right? So he's happy. He's telling everyone, I landed a promotion, right? And he tells people, I am better off, right? He tells people, I'm better off. I am doing better for myself now. I'm earning more money. Okay, so once again, there's still only one good. Okay, there's still only one good he can buy, but now that good costs 30. That good costs 30. Right? That good costs 30. So essentially, once again, he can only buy 100 of that good. Okay. So my question to you guys is, has real income increased here? Has real income increased here? Yes, you can say yes. If it's no, you can say no. What do you guys think? It's an important concept, guys, to be clear. Okay, what is real? What is nominal? What is the difference between these two? Right, so the question for those of you that need a repeat is, has real income increased in this question? Yes or no? We've got a few answers so far, which is nice to see. Okay, so guys, in short, the answer is no. Okay, because what you have to understand, guys, is that real figures, okay, real figures mean in goods, in terms of goods, are you better off or are you worse off, right? It measures actually speaking, if you have more goods, you're better off. If you have less goods, you're worse off, right? If you have the same goods, then you're the same. That is what real figures measure, guys. Okay, even with real GDP, right? Now, if you notice, let's say this is 2 years, okay? 100 goods produced, $10 a good, GDP is 1,000. Another scenario, right? 100 goods, $20 a good, 2,000. Guys, here as well, we say that real GDP has not changed, right? How do you know that? When it comes to real figures, guys, what you have to do is you have to look at your goods, right? You have to look at your goods. If you have more goods, you're better off. And we say real income has increased or real GDP has increased. Whatever we're comparing, the real figure for that has increased. If it's come down, real figure has come down. If it stays the same, real figure has stayed the same. So then my question to you is, what has increased, right? What has increased, guys, is nominal income. Yeah, nominal income has gone up. Nominal GDP has gone up, not real. Not real. Okay, and essentially, guys, the difference between real and nominal is that nominal includes this. It includes the change in prices. Real, guys, does not account for prices, Real does not account for prices. It looks at actually, are you better off or are you worse off? Okay, that's what real figures looks like. Nominal has prices, guys. Nominal has prices, and that is why sometimes when you look at nominal figures, it's a little confusing. It's a little confusing, guys, because if you look at this economy, it looks like they have become double as efficient. They are amazing. Wow, they're performing great. They've doubled their output. No, they've not doubled their output. Their output has stayed exactly the same. All that has happened is their prices have increased, right? So sometimes looking at nominal figures can be a little bit, I guess misleading, right? And real figures give you the true picture. Okay, so it's important that you guys are clear on that concept before we jump into the question. Okay, so now let's go back and look at what the question is now that we have that understanding. Right, so GDP in a country in current prices increased by approximately 8% in one period and the next, but real GDP fell by 2%. Which one of the following explanations is the most likely? Okay, so guys, real GDP fell by 2%. Okay, understood. What are they talking about here? GDP at current prices, right? Increased by approximately 8%. Guys, this is your nominal GDP. This is your nominal GDP. Okay, that is your nominal GDP. So essentially, what you have to realize, guys, is this. Something like this has happened. Okay. Nominal GDP has maybe gone up from 100 to 108. Okay. Real GDP, on the other hand, has come down maybe from something like 50 to 49 in terms of quantities, right? So guys, my question to you then, okay, these are prices, right? Remember guys, quantity into price will give you the value. So my question to you is, between year 1 and year 2, what do you guys think has happened to prices? What do you think has happened to prices here? Have they gone down? Have they stayed the same? Have they increased? What do you guys think? Because they tell you what? Nominal GDP has gone up. How much? 8%. This is real. These are your real figures. What has happened to these? This has come down by 2%. This has come down by 2%. So the question is, guys, what has happened to prices here? How do you get these numbers? Have prices gone up? Have prices come down? Have prices stayed the same? What do we think? If you want, you can put numbers in the calculator and get the answer through that as well. You can just multiply and see and figure out what happens to the value of X. Yeah, guys, what do we think? Have prices gone up here? Have prices come down here? Have prices stayed the same? Yeah, right. So guys, prices have very evidently increased here. I mean, if you notice, this will be 2, right? This will obviously be something higher than 2. This will be something higher than 2, right? So essentially, gone up. Prices have gone up. So when you have a look at this, guys, any options that say fell, you have to immediately eliminate, right? 1 and 2 are gone. 1 and 2 are immediately gone because it says fall, right? Prices not fallen. Your prices have gone up. You've just seen, right? Now we have to figure out by how much prices have gone up, right? By how much prices have gone up. So we can eliminate this example and instead turn our attention to a particular question or equation rather, I should say, sorry. So real GDP, guys, okay, will equal nominal GDP minus changes in the price level. Minus changes in the price level. Okay, all of these guys can be in percentages. Okay, so what has happened to real GDP? Fallen by -2. What has happened to nominal GDP? Risen by 8. Price level is the term we need. Cross this here, cross out the signs, x equals to 10 or 10% as a positive figure. Okay, the fact that it's positive tells you prices have risen. Risen by how much? 10%. 10%. So your answer, guys, is going to be 5. Okay, your answer for this question is going to be 5. Right? It's very, very important, right? Not just here, but in general, for you guys to understand the whole concept between real and nominal. All right. So, guys, before we go any further, is that clear? It's an important question. It's an important concept, moreover. So, are we clear with that? Okay, right, guys, great to see, great to see. So if anyone at any point is not clear, all you have to do is just let me know. Okay, so that is what happens with this question. All right, let's move on to 24. Okay, so guys, 24, have a go. Let me know what you guys get. This should be a question where you get the answer like this. Let me know what you guys get. Okay, okay, glad to see some answers coming through. Right, guys, I'll give you a little more and then we'll discuss. Okay. Okay, righto, guys, good stuff. Let's have a quick look how we arrive at the answer here. Okay, so what are they asking you for? They're asking you which an increase in which of the following will cause a decrease in aggregate expenditure. Yeah. So first of all, let's write out the formula for aggregate expenditure to see if maybe one of the options link up to this. Yeah. C plus I plus G plus X minus M. Okay, perfect. Right. So increase. Guys, if consumption expenditure goes up, you'll notice aggregate expenditure goes up. So that can't be the answer. Government purchases, same thing. Right? Investment expenditure, same thing. What about import expenditure, guys? Right? Import expenditure. Okay, let's have a look at import expenditure. Oh, there's a minus sign here. So the higher this is, the lower aggregate expenditure is going to be. So that fulfills our requirement. That is what is going to be our answer. Okay, so your answer here is going to be 3. right? Your answer is going to be 3. Okay, righto. Guys, 25. 25 is a good question. I want you guys to attempt this and let me know what you get. Right, so guys, I'll give you a hint. You can actually use that formula that we made use of just for the question before. Okay, to use that and actually get the answer for this. Seeing some answers coming through already. Very nice, very nice. Okay. Right, guys, maybe a minute more at most. Okay. Most of you guys are doing pretty well for this question, which is nice to see. Okay, right, guys, let's discuss. Assume that in a closed economy. Okay, so guys, the fact that they say closed economy means that the country is like this. It is self-sufficient. It has closed itself off from the rest of the world. So in other words, people inside the country can't sell goods to people abroad as exports. They can't get goods from abroad into the country as imports, right? So your aggregate expenditure function no longer looks like this, guys. Okay, it looks like C plus I plus G. Okay, but in this case, guys, I don't think they're even asking us to do anything with G. I think they've given us consumption as a function and they're asking for investment. They've also said something else here, right? Equilibrium level of national income is rupees 4,000 billion. Yeah, it's rupees 4,000 billion. So guys, at equilibrium, we know aggregate output and aggregate expenditure equal one another. Yeah, so I'm going to drop G as well for the time being, guys, because they clearly haven't mentioned it, right? So clearly 4,000 will equal to C, but guys, you can't write C because the capital C is here. Yeah, this is the function. So substitute the function. Instead of writing this C, write 200 plus 0.8 Y. Yeah, write 200 plus 0.8 Y plus I. Okay, right. So guys, where you see Y here, right? Where you see Y here, you can use this Y because of this, right? So we've been given the figure of Y, guys. So substitute that. So this is 0.8 into 4,000. Right. Okay. Now, all you do, guys, is multiply this out. Okay, 4,000 equals 200 plus 0.8 in 400 is 3,200 plus I. Okay, so when you add these two up, guys, it comes to 3,400. Take it to the other side. 4,000 minus 3,400. 600 is your investment. 600 is your investment. Let's see if there's an option like that. Hopefully, we've done the question right. Okay, see 300, 1,600, 400. Okay, 600 is there. 2 is your answer, right? And most of you guys got this right, which is super nice to see. All right, 2 is your answer. Okay, righto. So guys, I'd like for you to give question 26 a go, right? Question 26 is a little bit of an interesting question. Have a look at this and see. Tell me what you guys get. Right, so guys, this is a question or if you're struggling a little bit, that involves the use of something called a multiplier. Okay, I'm not going to tell you which type, right? But I'll tell you that it involves something called a multiplier. Okay, so guys, I'll give you a little more time. Okay, then we'll discuss. These are good questions, guys. They're testing important concepts. Okay, so I hope you guys are getting it, working through it. If you're not clear with anything, please ask. Okay, righto. So, guys, let's discuss now. So here, let's first look at what's happening. Suppose an economy is currently operating at an equilibrium level of output of rupees 3,000 billion, and to achieve full employment equilibrium, it requires to produce an output level of 4,000 billion. Okay, so how much are we short by? Short by about 1,000 billion. Okay. The economy's marginal propensity to save is 0.2. Okay, understood. MPS is 0.2. What would be the most appropriate policy recommendation for this economy to achieve the full employment equilibrium? In other words, what they are very simply asking you is how do we increase output by about 1,000? Yeah, that's what they're asking you. So essentially, guys, this, look at the options they've given you. Yeah, options is increase government spending, decrease government spending, increase taxes, decrease taxes. Those are the things they've given you, and they've given you certain amounts, right? So clearly, it is a change in a certain element, right? The change in a certain element. That element gets amplified through something we call the multiplier, and that figure has to equal 1,000, right? That figure has to equal 1,000. That is what this question is about. That is what this question is about. Where it gets a little tricky is in figuring out which multiplier to use, right? In figuring out which multiplier to use, because we know that there are few multiplier formulas. Okay, so what I'll do is I'll take two of these formulas, right? We'll see if we can use both first of all. If we can use both, let's use both and see if we get the same answer. If not, let's stick with the one that works. All right, cool. So essentially, the two multiplier equations, guys, that we're going to work with is tax multiplier. Okay, there's something called the tax multiplier. There's something called the government multiplier. Okay, there's the tax multiplier, there's the government multiplier. Okay, so what is your government multiplier equal to, guys? For the most part, your government multiplier is like the usual normal multiplier equation. Okay, it is 1 divided by MPS into the change in G, G being government expenditure. Here, we already know this answer has to equal 1,000. This answer has to equal 1,000. Okay, right. What about the tax multiplier? Now, this answer also has to equal 1,000. Yeah, why? Because what did I say? End goal is to, increase output by 1,000. That's the end goal. What we need to figure out is this, right? This. Okay, right. Tax. How do you figure out tax? It's MPC over MPS into the change in T. Okay. So what we can do now is, let's figure out this one first. Okay, they've given us MPS, right? 0.2. Fair enough. Okay. 1 over 0.2, which is 5. Okay. 5 into change in G equals 1,000. What will G equal to? G, guys, is going to equal 200. An increase in G of 200. Okay, an increase in G of 200. Okay, right. Guys, I have a question for you. We have MPS. Yeah, we have MPS. How do we find MPC? How do we find MPC? Can you find MPC? Have they given us MPC? What do you guys think? Is there a way to find it? Is there an equation to find it? How do you guys find MPC? If you know the number, you can tell me the number also. Yes, yes, very well done, guys. Consumption and saving, guys, is essentially like this, right? It's like two different sides of the coin, right? Both of them have to add up to 1, right? It's like you have a certain income, disposable income, that has to equal to consumption and saving. Consumption and saving anyways behave that way, where they add up to this. Yeah. So MPC and MPS also, guys, behave in a very similar fashion, right? MPC plus MPS equals to 1. Yeah. So if you're given MPS, all you have to do is just minus, 1 and 0.2, you get MPC, which is 0.8. Which is 0.8. Okay, right. Minus 0.8, 0.2, which is 4, right, into the change in T, which gives you 1,000. Yeah, so clearly, guys, the change in T comes to 250. Yeah, comes to 250. Comes to 250. Okay. So guys, essentially here, keep in mind that we have to cut taxes. Okay, why? The goal is to increase output. Yeah, the goal is to increase output. So either we increase government expenditure or we reduce taxes, right? You can't do it the other way around, right? Does not work. You do one. Either you reduce taxes, that will boost output, or you increase government expenditure, that will also boost output, right? One or the other. So now the question is, first of all, we have to find an option that talks about decreasing taxes and it has to equal 250. Or we have to find an option that talks about increasing government expenditure and that has to equal 200, right? So now what we have to do is we have our things here. Let's scan through the options and see whether or not it matches. Okay, let's have a look. Okay, right. Increase government spending, increase government spending, increase government spending. Perfect. No worries. No worries. All of them speaks about increasing government spending. All of them could potentially be our answer. Now let's check for the number. Yeah, let's check for the number. 200. An increase in government spending of 200 billion. Let's see if there's a 200 billion. Okay, there's a 1000 billion, there's a 500 billion, there's a 250 billion. So you're telling me if you increase government expenditure by 200 billion, output will increase by 1000 billion, right? Yes, that is true. But that option is not here, guys, right? That option is not here. So in other words, this can't be answered. This can't be answered. Let's have a look and see if this option is there, is where we're reducing taxes by how much? 250. Okay, let's look. Decrease direct taxes by 1000. No. Decrease direct taxes by 250. There we go. That is your answer. That is your answer. 5 is your answer. Okay. 5 is your answer. Right? And that's how you get it. That's how you get it. And we had to use both multiplier formulas just to make extra sure. Right? Because the thing is, guys, if you went with this, because this is generally the standard one. Yeah. If you went with this, right, and you realize this wasn't there, it's stuck. You'll be like, oh, what else can I use? Right? So have a few alternatives to kind of fall back on as well. All right. Okay, guys, 27 should be a pretty easy one, but I'd like for you to give it a go, right? As quick as you can get the answer, let me know. What do you get for 27? Okay, guys, nice to see some answers coming through. I'll give you a little more time and then let's discuss. Okay, but good stuff, guys. Good speed also. Yeah. Okay, right. Oh, guys, answers are piling through. Very nice to see. Let's have a quick look. So, guys, for the most part, national equilibrium is influenced by what? It is influenced where y equals AE. And what is AE equal to? C plus I plus G plus X minus M. So all you have to do, guys, is check whether this equals to this. And if it does, that is your answer. This is a condition for national equilibrium, right? For equilibrium. So guys, I want to ask now, this is one condition, yeah? Do you guys know of any other conditions for equilibrium? Is there something else that we can use? or used in conjunction with this, or in addition to this, or alternatively? Is there another condition that ensures equilibrium? Not relevant to this question, not relevant to this question, but relevant to this topic. Do you guys know of another equation that brings about equilibrium? Or if those, if two things may be equal one another, it's equilibrium. Do you guys know of another equation like that? Think a little and see if you guys can remember. Right? Again, not relevant to this question, but like we did in last time's task, guys, we explore a lot of just related concepts around the topic. Okay. Okay. So guys, another condition that is there is essentially your injections and your withdrawals being equal to one another as well. Okay, I'm pretty sure you guys must have seen W equals J. Yeah, J being your injections, W being your withdrawals, or J being your injections, W being your leakages, as they're sometimes called. Yeah, in the circular flow, guys, we arrive at equilibrium where your leakages equal your injections. Everything pumped into the system should equal everything taken out of the system. That is another place where equilibrium is ensured. We'll come to that a little later, but just for your knowledge. Okay. So getting back to the question, guys, you have to basically look where this and this are equal. Yeah. So they are asking you guys for where it is in this equilibrium. So that means 4 must be in equilibrium, 1 must not be in equilibrium. Yeah. And when you scan through the options, guys, it's pretty clear that the first one does not add up. Yeah, it is in disequilibrium, and that is our answer. Okay, 1 is our answer here. Okay, so guys, before we move into the longer response forms of questions, is everyone clear with all the topics and all the MCQs that we've done so far? If anyone's not, let me know. We can go back and cover it again. But if you're clear, let me know as well, and then we can move. Okay, right, guys, looks like we're good. So let's move to right. So guys, injections and leakages, I just told you about them. Yeah, injections are essentially things pumped into the economic system, whereas leakages are flows out of the economic system. Okay, but what I want you guys to do is, can you maybe name 1 or 2 injections for me? If you can name more, name more. And then name 1 or 2 leakages for me. If you can name more, name more. Let me know what you guys get. Think of what an injection is. Think of what a leakage is. If you want to tell me only leakages, you can tell me only leakages. If you want to tell me only injections, you can tell me only injections. Yeah, whatever you guys are comfortable. If you want to tell more than one, tell more than one. Up to you. Okay, righto. So guys, injections and withdrawals are essentially three, right? So essentially, if you have your circular flow here, injections is anything that comes in, denoted by J. Withdrawals is anything that goes out, denoted by W. Okay. So when it comes to your injections and your withdrawals, guys, this is essentially when you're dealing, guys, with a two sector and then you expand it, yeah, to three sector, four sector. It's no longer just the household and the firm. Yeah, it's no longer just the household and firm. You have financial institutions, then you have the government, then you have the international economy. Yeah. So with each additional person that is added, there are new things brought in and there are new things taken out. One for each of the three sectors, basically. Yeah. So there are three injections. There are three injections. The first injection, guys, is investment. Is investment, right? When you have financial institutions in an economy, what it does is it creates a channel to take savings from people who have too much money and give it as loans to people who don't have enough and use that money to invest. Use that money to invest. Okay? In a two-sector economy, your injection is investment. Is investment. Okay? Right. In a three-sector economy, this is where the government comes into the fray, guys. Okay? When you have the government in the picture, guys, the government itself being there is a big thing. Why? Because the government, guys, they spend money on goods and services, building roads, building schools, building hospitals, funding defense, right? The government spends money. The government pumps money, injects money into the economic system. So government expenditure is itself a injection. Last one, in a four sector, when you open things up, guys, exports act as the injection here. Why is that the case, guys? That is the case because you produce goods, you send them abroad, right? That generates, guys, basically that brings in foreign currency, that brings in more money, right? So essentially that forms exports, right? That is why exports are an injection. When it comes to withdrawals, guys, withdrawals are essentially also can be, you can go two sector, you can go three sector, you can go four sector. Okay, you can do that. So in a two sector, guys, if you remember, certain people have more money than they, than they essentially want to spend. They give this out, right? As what? Savings, savings, right? So that is the leakage in a two sector. When it comes to a three sector, guys, now the government, guys, doesn't have an unlimited supply of money, right? They also need to get this money from somewhere. So where do they get this money from? From the people, from businesses, right? Through direct taxes, through indirect taxes. You don't make a distinction per se, you just put the entire thing here as taxation. It's taxation. Okay, right. In a four sector, now guys, in the same way that we are getting money when we sell goods abroad, we also, guys, import goods. Yeah, as a country, guys, we can't produce everything. We can't produce everything. What we do is we buy some goods from other countries, and as a result, we have to pay them. Money is going out, right? And it acts as a leakage. This becomes imports. This becomes imports. Okay, so these are your injections, these are your withdrawals, these are the examples. Okay, keep that in mind. All right, so guys, second question, pretty straightforward. Let's have a look at the third question. Okay, let's have a look at the third question. So guys, when it comes to the third question, what can you guys tell me? Yeah, you don't have to type out long answers, guys, but just give me your thoughts. Maybe just a couple of words why this is different from this. What do you guys think? But guys, that's not the only part of the question, right? If you notice, the question has two parts. The question itself, guys, carries 4 marks. Okay, so that's quite a large sum there. Number one, explain how GDP is calculated. So first of all, if you know a couple of ways in which GDP is calculated, tell me that. Okay. Two, show how GDP at market prices is different from net national income, right? That is the second part of the question. So essentially, guys, whatever part you're comfortable with, if you're comfortable with both, give me responses for both. If you're not, then that's okay. Just tell me answers for either part, just comments that you have for either part. That will be more than sufficient. I'll give you guys a little bit of time and then we can discuss. Remember, first part is GDP being calculated. Second part is how GDP differs from net national income. We can start with the calculation one, guys. It's pretty easy, right? I'll give you a hint. There are 3 main ways to do it. Yes, guys, I'll give you a little more. Okay. Anyone wants to send across their comments, please do. And remember, you don't need to answer both parts of the question. If you only know one, answer one. Okay, righto. Guys, explain how GDP. So first of all, guys, start off by telling the examiner, right? Before just saying, okay, GDP is calculated using this, tell them. Tell them, show them that you know what GDP is, right? So guys, GDP is the market value of the total goods and services produced by an economy. That is GDP, gross domestic product. Okay, right. Once you show, okay, right, I know what GDP is, then tell them how is GDP calculated. So guys, GDP is calculated in a very elementary way through one of 3 ways, guys. Yeah, all 3 should get you the same answer if you do it correctly. There is the expenditure approach. There is the output approach, or you call it the production approach sometimes. And there's the income approach. Yeah. So essentially, guys, with the income approach, what you do is essentially you say, look, people are employed in the economy to produce certain goods and services, add up the incomes of all these resources. That is the income approach. What is the output approach? Now, these people are essentially these people are being employed, right, to produce certain goods and services. Now, these goods and services have a value. Add up the outputs of, or rather add up the values of all these outputs. That's the output method. What is the expenditure method? When these people have incomes, right? They need to eat, they need to drink, right? They need to eat, they need to drink. So essentially, they will spend their income on buying these same goods and services that they helped in producing. So what? They're spending their money. What is that? Expenditure. Expenditure method. All these three should equal one another. It's like saying a $1 note passes from me to you, you back to me back to you. That is what is happening. But throughout the economy, and that's why it's called sometimes the circular flow, because it's a circle and it's flowing. It's constantly just moving and moving and moving. Okay, right. So essentially, guys, that answers the first part of the question. What about the second part of the question? Now, the second part of the question talks about how GDP is different from net national income. Now, guys, if GDP is like this, net national income is like this. It's an expansion of it, essentially. Okay. Net national income, guys, takes GDP, right? It takes GDP. Now, what we say is this. Now, GDP, guys, involves you sometimes producing capital goods, right? It involves you producing capital goods. But that being said, guys, let's say an economy had 20 capital goods before, okay? But during the year, guys, due to wear and tear, due to whatever reason, 5 of these machines have gone kaput. They're gone, they've depreciated, they've got damaged, can't use them. Now, in the new year, or for this year, we produce machines. Okay, at the start, we had this 20. Over the course of the year, 5 got damaged. Now, by the end, we have produced 15 new machines. We have produced 15 new machines. Now, these 15 will get captured in GDP. This 15 will get captured in GDP. But what we say with your essentially your net national income is, look, 15 doesn't add to your productive capacity, right? Why? Because before getting 15, first of all, use 5 to kind of, replace this. Use 5 to replace this. There's some capital that's been worn down, right? There's some capital that's been worn down. And that is essentially that capital replacement, that depreciation that happens is accounted for here. So effectively, guys, look, your productive capacity isn't increasing by 15. No. Your productive capacity is increasing by 10. So net national income, guys, captures this depreciation. It captures this wear and tear. It captures that, because we say whenever we produce something new, it's not new. Part of it has to replace the old stuff, right? And that is captured in net national income. So it's GDP minus any depreciation plus any factor or property income you get from, things or people that you have abroad. Any money that comes in gets captured under net national income as well. Okay, so that is your answer here. Okay, that is your answer here. All right, so guys, I would like for you all to give this a think. Question 4, right? Why do we consider a business cycle expansion different to economic growth? Are they the same thing? Do people think they're the same thing? Right? Why are they different? Why are they different? Again, guys, you don't need long responses. Just use a few words here and there, a few short phrases. That will be enough for me to get the picture as to whether you guys are comfortable or not. Okay, guys, I'm seeing some answers come through, which is really nice. Just think, guys, even if you're not sure what one of them is, just say, okay, I know what this is, then explain that. So as a business cycle expansion, I think you guys should know. We discussed it a little earlier. I'll give you all a little more, then we'll talk. Okay, right, guys, let's discuss. So, guys, when it comes to a business cycle expansion, right? When it comes to a business cycle expansion, it's what we discussed earlier. It's where you just come out of a trough and you're beginning to expand. Yeah. And remember the things that I told you are happening. What I told you is happening is essentially you are growing. Yeah. But guys, you're not growing using anything new. You're not like, doing anything new here. It's resources that you had that were unemployed that you're now re-employing, or resources that you had that are now working a little more efficiently, right? That is expansion. Yeah. It is the recovery of an economy. It is you growing towards essentially your peak before you thereby go back into a correction and a trough and whatnot. Okay, that is what we call a expansion. When it comes to economic growth, guys, economic growth is a little bit more of a long-term concept. Yeah, economic growth is when your resources become more effective. You get more technological resources, right? That you innovate. That is economic growth. Economic growth is more long-term. We say the productive capacity of the economy increases. Okay, the productive capacity of the economy increases. Okay, and guys, most of the answers you all sent me are correct. Okay, so you guys send me answers. So far, everything I saw, everything kind of matched the bill. Okay, so that we say that expansion is a little bit more short term, right? You're using resources you already have, they were unemployed, now you're re-employing them. Economic growth is where essentially you create new resources, you get more resources, they become more effective, your technology progresses. That is economic growth. That is what is economic growth. Okay, that is what happens there. So guys, essentially in terms of your mark breakdown, 2 marks will be used or allocated rather for this, and 2 marks will be allocated for this. Okay, right. So guys, I would like for you to give question 5 a go, part 5 rather. Do A and B together. Okay, so do A and B, give me the answers for both. I'll give you guys about a few minutes. Give me the answers for A and B together. It's a very simple question. Let's see if we can do it in a record short time. Okay, send me your answers for this. Yeah, so guys, remember some of the formulas that we've used earlier that will help you get your answers here. Okay, stick to those and you'll be good. Okay, guys, nice, nice, nice. Good answers coming through. Give you all a little more time, though. Okay, righto, righto, guys. I think you guys are on the right track. Okay, so let's discuss quickly, not spend too much time on this question. So guys, you're asked to calculate GDP, right? So GDP, as you guys know, is C plus I plus G plus X minus M. Okay, if I'm not mistaken, I think all those figures have been given here, yeah? So C, which is 700, I, which comes to 200, G, which comes to about 300, X at positive 375, and imports M at minus 325. So I think if you add all of those up, you should get a final GDP figure of 1250, right? Income. That. Okay, so that should be your answer for part A. Part B, what is the personal disposable income, right? Well, what is this disposable income talk now? Didn't we just get income here? Yeah, but guys, this is like the income you get from your job, right? This is the income you get from your job. Now, to this, you need to make a few changes, right? What do you need to do to get disposable income? What you have to do is you have to take off any taxes that might be there. Okay, you have to take off any taxes that might be there. Why? How do you define disposable income? Disposable income is the income you have in your hand for spending and saving, right? Now, you can't say your normal income, guys, is disposable income because you don't get to keep all of it. You have to give a certain amount of taxes for the government, right? So, but guys, what you have to realize is the government is not all bad. Okay, it's not just that they're taxing you and they're not doing anything for you. No. They also can provide you with certain benefits, and that adds to your income, guys. Transfer payments. There we go. That, right? So essentially, what do you do here? It's 1,200, right? Minus 550 plus 300. That is disposable income, right? So always think of the definition: income in hand for spending and saving. Generally, your gross income minus anything you paid to the government and anything you receive from the government. That's how you get it, right? And that answer, I believe, should come to 1,000 billion. Okay, that answer should come to 1,000 billion. That is your personal disposable income. Okay, right. Okay, guys, let's move on to question 5. Right, let's move on to question 5. Let's have a look at statement number 1A. Okay, they've given you the aggregate consumption function. They've given you investment. Guys, do you want to maybe try finding the equilibrium level of income here? Right, okay, it's nice to see some answers coming through. Okay, righto, guys, let's discuss. Suppose an aggregate consumption function for a simple economy is given by this, investment is this. What is the equilibrium level of income? Right. So, guys, let's write this out. Yeah. Y equals to C plus I. Do we know what Y is? No, we've been asked to find it. Okay. Let's write out C in its full form. 100 plus 0.8 Y. Investment is 200. Okay. Right. So what we can do is we can take the like terms to one side, right? Where it becomes Y minus 0.8Y, which becomes 0.2Y. 100 plus 200 adds up to 300. Yeah. Right. Then what? Simply divide. 300 divided by 0.2, that should give you 1,500 as your income. 1,500 as your income. This is the value of Y. Okay. So guys, I'll give you a hint. This is going to come in handy for your next question. Okay. So with that in mind, guys, let me know what you get for B. Let me know what you get for B. The level of saving at equilibrium. Yeah, guys, you can also think back to something we did a little earlier involving the relationship maybe between savings and consumption. Yeah, that'll help. Okay, cool, guys. Good answers coming through. Let's discuss. Right. So, guys, if you remember, like I said, consumption and savings are two sides of the same coin. Yeah. So essentially, if you have income, that equals consumption plus savings. Okay. We know what income is, right? Yeah. We know what income is. We know what consumption is as well. So make savings the subject, right? Make saving the subject and do this. So what is income going to be, guys? 1,500. Okay, understood. Consumption. Let's have a look at the consumption function one more time, just so that we're clear. Okay, 100 plus 0.8y. Okay, so it will be 100 plus 0.8 y. 0.8 of 1500. Okay, 0.8 of 1500. This, guys, adds up to 1200. 1200 plus 100 is 1300. Then what's your answer? 1500 minus 1300. Your answer is 200. 200 is the value of your savings. Okay, and I saw a lot of 200s in the chat, which is good stuff, guys. Okay, keep that in mind. All right. Next up, guys, when we look at the third question, if for some reason aggregate output were at the level of 1700, what would the level of involuntary inventory accumulation be? Right. So for this question, guys, essentially what you need to know is that equilibrium happens at this, right? Aggregate output equals aggregate expenditure. What is the scenario? 1500, 1500. That's what is there in equilibrium. But what has happened now is they are saying, look, aggregate output is at about 1007. Right? Aggregate expenditure is at about 1005. And they're asking for something called involuntary inventory accumulation. What is that all about? Guys, what that is about is essentially this. This is like what people buy basically. Okay? It's like demand, how much people buy, how much people are spending. That is this term. This is like output, how much people are, how much firms are producing, right? What people are buying, what others are selling. So equilibrium happens where buying equals selling. So here what happens? Selling is more than buying. Yeah, selling is at about 1007, buying is at about 1005. What's the gap? The gap of 200 says, look, you can produce 1007, people only buying 1005. So how much ends up being traded in the market, guys? Only 1005. So what happens to that 200 difference? That 200 difference is kept with you as inventory, accumulated inventory on an involuntary basis. So 200 is your answer, but you have to accompany it with that explanation that I gave as well. It's excess supply basically. Okay, right. So guys, that is your answer for C. If we look at 2, guys, if we look at 2, so 2, guys, again has to do with the multiplier, right? It has to do with the multiplier, basically saying why is a 500 reduction in government purchases larger than a 500 million tax increase, right? So basically both of these guys reduce GDP. Yeah, there's no doubt about that. Tax increase is bad, government expenditure fall is also bad. No doubt about that. But they are saying, why is the government expenditure change more? Why does it affect GDP more? Why it affects GDP more, guys, is because, if I were to write out my equation for you, yeah, aggregate expenditure equals C, right? Or let's say, whatever this figure is, plus C, right? Y minus T plus I plus G. So guys, here what you have to understand, right, is when G falls, the full effect of G, all 500 of a fall in G will hit this. It will hit this and this will be impacted by a lot. Yeah, the full effect of G will hit this. But guys, when taxation changes, if you notice, taxation is not directly in this equation. Taxation, a part of it affects disposable income, that affects consumption. And then it is consumption that affects expenditure. So the whole effect of tax, guys, is not felt. Only a fraction of tax will be felt. Yeah, for example, if this is 0.8 here, right, the entire tax is not felt. Entire tax is not felt. Okay, so it's only a portion or a part of tax that affects the final output. Yeah, whereas government expenditure, guys, is the entire thing. It's the entire thing. Okay, so that keep that in mind. Keep that in mind. Okay, right. That's what happens here. That's what happens here. Okay, right, guys. Next up, let's have a look at 3. Okay, so guys, you can give me your answers in any order, right? You can do A, B, C. You can do C first, then B, then A first, then C second, then B third. Any order, guys. Let me know what your answers are for this question. 3. So guys, I'll give you a hint for part A. It's what we were doing just before. That whole link between consumption and savings. That's what happens in part A. So guys, remember when you're sending answers, if you're not sending in order, just let me know what is what. Okay, or like say savings is 2,200, then I can understand, okay, it's part A. So guys, here you don't need to give all your 3 answers together. You can give even one at a time. That's fine. Okay. Okay. Righto, guys. Let's discuss So let's first analyze what we've been given, yeah? Because I think there's a lot of things to kind of dissect here, guys. Assume that GDP income is 6,000 million. Personal disposable income is 5,100. Budget deficit is 200. Consumption expenditure is 3,800. Trade deficit is 100. Okay, let's write these terms now, guys. Yeah, let's write these terms and see. How do you get personal disposable income from actual income, guys? How do we get that? That we can get by saying YD equals Y minus taxes. Yeah. So we have this. We have this, which tells me what? Taxes are 900. From the first line alone, guys, we have got the figure for taxation. Is it asked for? I don't know, but I got it anyway, right? Right. What's next? Government budget deficit is rupees 200 million. What does that mean? What's a budget deficit, guys? Basically, what it means is the budget is government's income versus the government's expenses. If it's a surplus, income is more than expenses, like a profit basically. If it's balanced, they are the same. If it's a deficit, then its expenses are more than income. So that being said, this is your income. This is your income. Yeah, and they're telling you we're at a deficit. They're telling you they're at a deficit of 200. So in other words, guys, government expenditure is going to be 200 more than this. It's going to be 200 more than this. Why? Because expenses are more than income by 200. We have a deficit of 200. Yeah. So it's 900 plus 200. This becomes 1,100. Okay. It becomes 1,100. Okay. Right. Is that needed? I don't know. Let's check a little later. Okay, then they tell me something called, okay, trade deficit is rupees 100 million, guys. Trade deficit talks about the international economy. How are you performing there? So essentially trade deficit means, guys, imports are going to be more than exports. Yeah, by how much? $100. Okay, understood. We're clear. Okay. Now we can get into the questions, guys. All of this that we just did, guys, is pre-work. It's just pre-work. It's just getting us ready for the actual question, right? That is what happened here. That was what was happening here. Okay, we're just getting ourselves ready for the actual question. Now they say, what is the amount of savings? Okay, what is the amount of savings? Okay, so guys, if you remember, savings and consumption, about the third time I'm telling this, is opposite sides of the same coin. So that being said, you have YD that equals C plus S. What is YD, guys? Do we know what it is? I think we do. 5,100. What is consumption? What is consumption? Consumption is 3,800. Which means, guys, savings has to be the difference between these two. Savings is 1,300. Okay. Savings is 1,300. Okay, right. Next up, guys, let's scan through the other two questions. Okay, what is the size of investment? All right, cool. How much is government spending? How much is government spending? Now, guys, they are asking me, if I'm not mistaken, they are asking me for G, right? They are asking me for G. Didn't I already find G for them? I did. I found it here at the very start. Even before I knew what they were asking me for, I found G. So that's my answer for C. That's my answer for C. Okay, that's my answer for C. All right. Now let's get to B, guys. What are they asking for in B? What they're asking for in B is what is the size of investment? Okay, what is the size of investment? Right. So, guys, if you notice, we have the answer of X minus M here. Yeah, or M minus X rather. We have the answer of consumption. We have the answer of government expenditure, right? If we go back, isn't the only thing that's missing from this equation, isn't the only thing investment? It is investment. It is investment, right? So what do you do? What do you do? What you do is you just put the figures, guys. Really simple. Yeah, consumption is 3,800. Consumption is 3,800. Okay, this is 6,000. Investment, we don't know. Government expenditure, we do know. X minus M, what is it? If it's X minus M, guys, it's a surplus. Why? Exports are here, imports are here. M minus X means it's a deficit. M is here, X is here. So what are they saying? It's a deficit, right? So this must be a minus 100 then, yeah? Right. So let's calculate this right side, guys. 1,000 plus 3,800, 4,800. Plus X equals 6,000. X here being investment, guys, okay? So what do? Simply cross. Take this to the other side. X or investment equals to 1,200. 1,200. There we go. 1,200. That is how you get your answer for investment. Okay, right. So guys, before we go any further, I know there was a lot to kind of take in with that question. It was numerical sum, guys. You have to be very comfortable with these. Whatever way your examiner gives you, whether it's from here, whether it's from here, whether it's from here, you need to be able to kind of, rotate, pivot, and arrive at the correct answer. Okay, so remember, guys, do not get panicked when you first get a question. Read it, understand it, know your equations, know the links between things, and then just figure out where to start. Because once you figure out where to start, it's a natural progression and you can get what you need to get because of that. All right. So that being said, are we clear in this question, guys? Are we clear? If anyone is not, please let me know. If we're clear, give me a thumbs up, give me an okay, and we can move. Okay, so guys, just to show how we got government expenditure one more time, right? So first step, guys, is remember you have to determine taxation. Yeah, you have to determine taxation. So we can do that because we know that disposable income is the difference between income and tax. Yeah, so essentially we have income, we have disposable income, tax is the missing figure. Tax is the missing figure. Okay, so once you have tax, you know that we have a budget deficit of 200 million. You know that we have a budget deficit of 200 million. So guys, a budget deficit is like a trade deficit. A trade deficit means imports are here, exports are here. Budget deficit means government expenditure is here, taxation is here. So what is the gap, right? So the gap is what you call the deficit. So we know the deficit is 200. We know taxes are 900. 900 plus 200 gives you 1,100 as your answer. Yeah, that is how you get government expenditure. All right. So small doubt in regards to that. I hope that's clear. And guys, for the most part, it looks like we're okay. So we can jump. Okay, we can move. All right. So guys, looking at the fourth question, this is a pretty straightforward statement. Equilibrium level of national income is not necessarily equal to the full employment level of national income. That statement is true. That statement is true. Okay. Why it is true, guys, is because the equilibrium level of national income, there are two conditions for that. Condition number one is leakages equal injections. Condition number two is what you guys are already masters at by now, guys. It is where Y equals AE. Those are your two conditions for the equilibrium level of national income. Full employment level of national income, guys, is not the same thing. Equilibrium level of national income, guys, does not have to be at the full level of output. As long as those two conditions I told you are satisfied, you're at the equilibrium level. Yeah, that does not mean you're at the full employment level. Because full employment level means with all your staff fully employed, right? All your staff have been fully employed, you're making the most out of it, and you're producing at the maximum that you can. That is the full employment level. Yeah, that is not the equilibrium level. So there is a difference between those two. Again, this statement is telling you the truth in that regard. Okay, that's what happens here. That's what happens here. Okay, right. So guys, that is the 2017 questions for chapters 5 and 6 wrapped up with. Okay, last time we did it for 1, 2, and 3. Now we did it for 5 and 6. Next week we'll be doing it for 4. Okay, but guys, we do have a little bit of time left. So let's take a look at a few questions from the 2018 paper. Yeah, let's take a few MCQs at least to start off with from here and test our knowledge. Okay, right. So guys, 21, pretty easy question to get you all started off with. What do you guys think the answer would be here? This is about the circular flow. Just think about that, guys. Households, producers, what is flowing between them? Who is it flowing from who to who to? What are the links? Okay, so guys, 21, pretty straightforward. So in terms of what the circular flow looks like, guys, very simple. You have your households here. You have your firms here. Firms produce goods and services. Yeah. Households buy these goods and services. But it is households, guys, in order to buy these goods and services, yeah, the purchase happens here. In order to purchase these goods and services, you need money. So how do they get that money? They get their money by working a job. Yeah, by working a job. So essentially, what are they doing? They are offering their resources, they are offering their services. Yeah, and in return for their services, they make an income. This is your circular flow. Yeah, households provide their services to firms, firms use those services, produce goods and services. In return for the services you provide, we pay you money. The money you have, you need to live. You buy goods and services with this. That's what happens here. That's what happens here. Okay, right. This is your circular flow. So in terms of what your answer is, guys, we'll say households and suppliers, or rather households are suppliers of productive resources and business firms are producers of goods and services. That is what we just spoke about. 3 would be your answer. 3 would be your answer. Okay, right. Guys, this should be a pretty straightforward question. Let me know what you guys get for this, for 22. So this is a question, guys, where if you know the definition by heart, you memorized it, you've understood it, this should be a very, very easy mark for you guys. You should be able to do it relatively quickly as well. Okay, so let's see what you guys are saying. Right. So guys, when it comes to GDP, we actually discussed the definition earlier. Yeah. It is, we said the total market value. Yeah. The total market value of, so if you notice guys, there are two main statements here: all output, all final goods and services. So guys, it's not all output, it's all final goods and services produced in an economy in a given time period. This is the word for word definition of what GDP is. Okay, so 3 would be your answer here. 3 would be your answer here. Okay, guys, I would like for you to give 24 ago. 24 is a very good question, guys. So guys, for 21, in case you guys missed it, the answer would be 3. Okay. Whereas for 22, the answer would be also 3. Now we're on 24. Okay. Guys, like I said, a fantastic question. Give you like a minute more here, guys. No. Okay, I'm giving you a little bit of time because I really want you all to think about this question. Okay, right, guys, let's discuss. So with these type of questions, guys, what you have to keep in mind is we generally use something called the value added method. Okay, the value added method, guys, is basically look at how much you sell something for. Yeah, the value of output. But don't just look at the value of output. Look at what is the cost of the inputs you bought and take the difference. That is called value added. Yeah, adding up all the value addeds, guys, gives you GDP. Yeah, generally you are meant to only take this value, right? But the thing is, guys, sometimes there's a problem known as double counting. Yeah, the problem known as double counting, guys, because of this. Now let's say you talk about the the wood processing industry. Yeah, now they'll cut down trees, they'll sell those trees, and they'll put it as their final output. Yeah, then guys, when you sell pencils, you have the value of that trees included there, and you are counting it again, right? So essentially, that is known as the double counting problem. If you always take the same, the final value, the final value, the final value, the final value, you're double counting. You're counting the same thing over and over and over and over again, and your GDP figure is going to look like this when it should be this, which is a problem. You're overstating it, right? So essentially, guys, here, what you have to keep in mind is you take value added, the difference. Yeah, you take the difference between your sales price and your bought price. So essentially, let's calculate value added for each of the three industries we've been given: A, B, and C. Okay, I'll write sales value here, I'll write bought value here, I'll write value added here. Yeah, and we can fill this in. Right. So sales value, guys, for A, the inputs bought value is about 30. Okay. What's the sales value like? The sales value is 100. All right. Value added comes to 70. Okay. Next up, industry B, no imports, sells part of its output to industry C for 300 and exports goods to a foreign country for 360. Now, what you have to keep in mind here, guys, is that these guys sold their 100 here to them, and it now becomes an input. Yeah, it now becomes an input. So this is their input cost. And this is what I told you guys with the wood processing example. Output here becomes input here. So if you include it, it becomes double counting. So right, 100 here. Do they have any other costs? No. They said no imports. Okay, right. No other costs. Output. How much is going to be the value, guys? They're saying 300 they sell to industry C. Okay, 300 they sell to industry C. Understood? There's 60 more. There's 60 more that they're selling abroad. Okay, right. So 60 plus 300. This becomes 260. Right? This becomes 260. Okay, right. Clear. What comes next? Okay, so guys, this 300 here, where does it go? C. It comes here. Okay, right. Are there any other inputs here? 300. Industry C uses 30 million of imported inputs. There we go. So this is this 300 plus 30. Right? And sells 500 million of it output to the final consumer. So 500 is the output value. Okay, so it's 500 minus 330. This is 170. Okay, so guys, now let's add this up and see whether or not we get an answer that is there. 70 plus 260 plus 170. I believe that comes to 500. Okay, 500. So this should ideally be the value of our GDP. So let's look and see. What is the GDP? 440, 960, 990, 900, 500. There we go. That is your answer. 2 is your answer for 24. 2 is your answer for 24. Okay. So guys, that is it. Time is up. Okay. We did a thorough revision today on chapters 5 and 6. If you guys have any doubts at all, right, you're free to put them now. Right? If not, and we're running a little late, I'll put my number down again for you guys. It is in the group, right? But just in case those of you aren't in it or can't find me, this is my number. You can make a note of it. You can WhatsApp me, text me, just a call or text away. We're always here to help, right? If there's anything you're not clear on, you couldn't ask it today, you need a little more support on, you want a few more questions on, right? Please reach us out, okay? And yeah, guys, then that's it for today. Everyone, I hope you guys stay safe, right? And are, studying well these days, and I will catch you guys in the next class. All right. So guys, good night. Take care, and I'll catch you all next time.